types of deposits in Indian banking system. In Indian banking system, the deposits broadly fall into two categories. The first category is called demand deposits and second category is time deposits. Demand deposits are also known as CASA deposits. CASA stands for current accounts and saving accounts. So as the name suggests, demand deposits have two segments. One segment is current account deposits or current deposits. Second one is saving bank deposits. So second category is term deposits. So term deposits are the deposits which have fixed maturity period. So the deposits with fixed maturity period are called term deposits. Now we shall have a look on these deposits one by one. First of all, we are discussing current deposit accounts. This type of account is opened by business firms because business firms need bank accounts for routing their financial business transactions. So for the purpose of financial transactions, the business firms need bank accounts, and for that purpose they open current deposit account. In this type of account, there is no restriction on number of deposits or number of withdrawals. So there can be any number of deposits or any number of withdrawals. On this type of deposit, no interest is paid by the banks for the balances maintained in these accounts. This means for banks it is interest-free money. So these are interest-free funds for the banks. But there is a high operational cost which banks have to incur on these deposits because of high number of transactions. And banks recover maintenance fee on these accounts due to high number of operations. Not only that banks do not pay interest on these accounts, banks also recover charges as maintenance fee because these accounts have high number of operations, and as a result the cost of operation to the banks is very high in these cases. In addition, banks prescribe minimum balance to cover their cost also, and in case an account holder fails to maintain that minimum balance, then banks recover additional charges. So current deposit account, it is maintained by business firms for the business transactions. Now let us move to next category. Saving bank deposits. This account is opened by individuals, and objective of opening these account is to save the money, to keep their saved money in a bank account and also enjoy liquidity, and in addition also earn some return on funds. So this account broadly serves three purposes. One, it helps in saving the money. Then on that money one can enjoy liquidity. In addition to liquidity, some return can also be earned, some interest can also be earned. As regards number of deposits, there is no restriction on number of deposits, but generally banks place a cap, banks put a ceiling over number of maximum withdrawals. So in these accounts where no restriction is placed on deposits, the ceiling is placed on number of withdrawals. Interest is paid on the balances in these accounts on a daily balance basis. So here the banks calculate interest on the daily balance basis. Interest rate in these accounts is fixed by banks themselves. This means different banks are paying different rate of interest on saving bank deposits. Many banks also insist on some minimum balance in these accounts, and in case the account holders fail to maintain that minimum balance, then they recover certain charges. Now let us move to third category, term deposits. So term deposits are opened by individual persons or maybe by corporates or other persons for earning higher return on their funds and also to enjoy liquidity. So in case of fixed deposits, in case of term deposits which are opened by individuals as well as by non-individuals, so these accounts earn higher interest rates and also provide liquidity. So account holders not only get good returns, they also enjoy liquidity. These deposits can be a single time deposit or a recurring deposit. Now single time deposit, this is called a fixed deposit account. So a single deposit account is called a fixed deposit account. Fixed deposit account may be having different variants. So sometimes accounts are opened where periodical interest payments are made by the bank. Even before maturity, the interest payments are made by the bank to the account holder. And another variant which is very popular, so deposit with facility of accumulation of interest to be received on maturity. This is the most popular one. Those who want a regular income, so they go for this option where they get periodical interest. And those who want to earn interest and get that interest accumulated and reinvested, so they go for this option. So in case of fixed deposit account or single deposit accounts, there are two variants. Another option here is recurring deposit account. If a person does not have large money in one go, in that case they can deposit the amount in monthly installments. So in recurring deposit account, the customers can deposit the amount in monthly installments and receive the entire amount with interest on maturity. Now term deposit earn higher interest rate and that vary according to maturity period. So rate of interest here is fixed according to maturity period. Generally for shorter maturity period, interest rates are lower, and for longer maturity period the interest rates are high. If amount of deposit, single deposit, is rupees 1 crore and above, then in that case banks can give differential interest rates also. As regards the maturity period of term deposits, so these deposits can be up to a period of 10 years. And to provide liquidity against term deposits, because they are fixed maturity period deposits, and to provide liquidity, so banks provide two types of facilities. So one is loan against security of term deposit, and another is premature encashment of the deposits. So banks also provide premature encashment of the deposit and other facilities. Banks provide loan against the security of such deposits. Now let us see the impact of composition of the deposits. Here we have put a picture of three banks: Bank A, Bank B, Bank C. So we have current deposits, we have saving bank deposit, term deposit, and we have total deposit. So data here we are showing percentage of total deposits. So in this bank, current deposits are 12% of total deposits. Here these are 16%, here these are 15%. Saving bank deposit, here we have 14%. In this case it is 22%, in this case it is 27%. Term deposit here 74%, here it is 62%, and here it is 58%. What is the impact of this composition? So the composition of deposits, it impacts overall cost of funds and profit of the banks. How? Let us see in this example. In this example, Bank A will have the highest cost of deposits, because in case of Bank A, the low cost deposits, that is current account deposit and saving bank deposit, is lower, just 26% total of these two. So these are interest free, this low interest, this is high interest. So here Bank A is having lower amount of low cost deposit, only 26%. Here the bank is having 38%, and here the bank is having 42%. So broadly we can say in this case Bank C may be most profitable. So in the given example, Bank A will have the highest cost of funds, Bank B and Bank C will have lower cost compared to Bank A. That is how the composition of deposits impacts the cost of deposits and accordingly the profit which the bank shall earn. Thank you friends for watching this video. I hope you have been benefited by the contents of this lecture. In case you want to have more about banking, please log in our website, call us or email us. Thank you.